Good morning, everybody. It's Tuesday, November 28th, 5:27 a.m. Central Time. Grain market's a little bit higher this morning. March corn futures up 0.75 at 476. March soybeans up 7.25 at 1355 and a half. March Chicago wheat up 3.5 at 564 and a half. March Kansas City wheat up 4 at $6 and a half. March spring wheat up 5.25 at 705. Let's start off with yesterday's sell-off in the corn market, which is pretty ugly.
U.S. corn and wheat futures fell to fresh lows on Monday. The December 23 corn contract bottomed near 454 per bushel, the lowest trade for any spot contract since January of 2021. The December 23 Kansas City wheat contract bottomed near 588 per bushel, the lowest trade for any spot HRW contract since July of 2021. Speculative selling, lack of a bullish catalyst, and December basis contracts may have all played a role in the sell-off.
I'll show you a March corn chart before I do some analysis here. So maybe we held some trend support on this daily chart. Maybe I'm reaching a little bit there. Here's the deal. So I think the farmer is undersold, and I think that for a couple of different reasons. I have been told for the last 3 or 4 months that the U.S. farmer is undersold as it relates to the 2023 corn crop. And why is that? I think there's 2 reasons. The first one is that over the last few years, we've become accustomed to higher prices. $6 corn, $7 corn, better than that in some areas, given these basis pushes. And we just never really had the opportunity to sell 2023 crop at those sort of price levels. The second one would be the weather that we saw this past summer. So in 2020, or not 20, I'm sorry, in June, we had a drought. And I think that during that drought, when the prices were at their best, farmers were very hesitant to sell because of the drought, because they didn't think that they'd have the bushels. Fast forward a couple months, yields end up quite a bit better than what I think a lot of farmers had thought, leaving them with overage bushels, unpriced bushels, and pair that with the fact that they just didn't do the forward selling that maybe they would normally do. Here's some data from CFTC, and maybe this isn't the best indicator, but the producer, merchant, processor, user category tracked by CFTC, they've got the smallest net short for this time of year in at least 10 years, which tells me that the farmer is probably undersold. And then we've got this basis contract situation. So if you've got a December basis contract, you're getting the phone call here this week that you've got to do something with it. And in the instance of a basis contract, for those of you guys don't know, you've locked the basis, but you haven't locked the futures price. And you're getting the call from your grain buyer today or tomorrow, maybe it was yesterday. Hey, you've got to either set the futures price on these December futures or roll it forward and eat the carry. So I think that has probably pressured the market this week too, because as I said, I think the farmer's undersold. And that leads me to, I'll just do our plug here right now. Yesterday, Chris Barron was on with me and we talked about this basis contract situation. We went through basis contracts, carry markets, rolling basis contracts, general best practices. You guys can add basis contracts to that list of things that I hate, because I really don't like basis contracts at all. If you guys want to see the premium stuff and you want to see that video, if you're dealing with this week, it's probably must watch stuff. Go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. Remember, guys, this is the best way to support what we're doing here. Support independent media. We have no sponsors. The only way we make money really is through the premium subs. Podcast pays us nothing. YouTube pays us enough to keep the lights on, basically. So check that out this morning. It's a really good video, and we'll send you along all of our other stuff as well.
Large money managers have increased their net short position in the corn market. CFTC released weekly commitment of traders data on Monday. During the week ending November 21st, the funds were net sellers of 27,000 contracts of corn. The net short of 202,000 contracts is the largest since mid-2020. Funds were net sellers of 9,000 contracts of soybeans and 20,000 contracts of SRW wheat on the week.
So that's a pretty heavy net short in the corn market. Same thing with SRW wheat. Funds still clinging to this modest net long in soybeans, which I guess is kind of the long leg of the spread here, if you want to put it that way. And the bean market still has a story, depending on your feeling on Brazil and the crop there and the dry weather that they've had in some areas. But the funds, I guess, kind of smell blood in the water here as it relates to the farmer being undersold. And they've been net short for a long time in the corn market.
Brazil's soybean planting is the slowest in 8 years. According to well followed private group Ag Rural, Brazil's 23-24 soybean planting was 74% complete as of last Thursday, down from 87% last year. Farmers continue to face hot and dry conditions in north central areas, while southern Brazil deals with excessive rains. Ag Rural is projecting this season's crop to reach 163.5 million tons. The group also reported that farmers in south central Brazil have planted 83% of this season's first corn crop, down from 88% last year.
No surprise that they're behind in terms of planting. This has been the case for a long time now. The forecast is kind of a mixed bag. These rains that are supposed to hit in central and northern areas of Brazil, this is going to happen, say, Friday, Saturday, Sunday into Monday. And then it may turn dry again. There is some rain on the radar this morning, but it's in these southern areas that have been far too wet, if anything. They've had like 3 or 4 times their normal rainfall so far this month in southern areas of Brazil. So I think the verdict is still out. I still think they need more rain. Whether or not the pattern shifts wetter during December is going to be a big deal when it comes to the soybean market and price action.
U.S. soybean shipments declined last week. USDA reported that 53 million bushels of soybeans were inspected for export during the week ending November 23rd. The print was down 12% compared to the previous week and 35% versus the same week last year. Corn shipments declined 32% versus the prior week at 16 million bushels. Wheat shipments were reported at 10 million bushels, down 25% compared to the prior week and 2.8% versus the same week last year.
Shipments kind of disappointing across the board. In the case of all 3 crops, we're not where we need to be to hit USDA projections. We've got logistics issues. I mean, the river is still problematic. And then you've got this whole Panama Canal situation, which is problematic. It adds a lot of distance and cost to shipping grain out of the United States. So we've still got export issues, which are long-standing issues that we've talked about at length. This is nothing new.
On Monday, President Biden announced a new White House council to oversee supply chains. The announcement comes amidst high inflation, which has fueled Biden's disapproval rating. The new White House Council on Supply Chain Resilience will meet every 4 years. The council's first report is due at the end of 2024. Supply chain issues following the COVID pandemic accounted for 60% of the surge in U.S. inflation, according to the San Francisco Fed.
So the impact of supply chain issues on inflation has essentially been erased, at least according to this metric, the New York Fed's Global Supply Chain Pressure Index. Biden wants to make sure that this doesn't happen again. And this is, as is everything in Washington, this isn't a jab at any politician, but Biden wants to get elected again. And inflation is a hot button issue, maybe the hottest button issue for a lot of voters. So they want to make it clear that they're taking some action here. And I would assume that this will result in lower input costs for all of you guys in 2024. That's kind of a joke, but I mean, input costs should be down a little bit, but not nearly where you guys would like them to be. I know.
The cattle futures exodus that began on Friday carried into Monday, with feeder cattle futures being hit the hardest. Over the last 2 sessions, feeders have lost an average of 12.28 per hundredweight. Live cattle futures lost an average of 6.27, reaching lows not seen since March. The declines are attributed to heavy fund selling, along with margin call liquidation and panic short hedging. Fundamentally, the markets are still facing an overall bullish outlook, with the beef cow herd being the smallest since 1962.
Just a nasty liquidation event. I didn't look at the CFTC stuff for cattle, but hopefully we're getting close to the end of this liquidation event. I mean, this thing has given back half of its gains for 2023. This is feeder cattle just in the last, 7-8 weeks. It's pretty ugly stuff. Outside markets here on Tuesday, guys. U.S. dollars about flat. Stocks are mixed. Bonds are flat. Crude oil is up 77 cents, and the January WTI at 75.63. Have a great day, guys. We'll talk to you on Wednesday.